Welcome to this explainer. If you've ever watched the market absolutely tank and wondered, hey, why is my portfolio sinking while all these big institutional traders are doing just fine? Well, you are exactly in the right place. Today, we're totally ditching the panic. We're going to look at precise, data-driven tools to measure market storms and, crucially, show you exactly how to size your positions so you can actually protect your capital. Okay, here's our roadmap for today. 1. The Volatility Survival Guide. 2. VIX, the Market Weather Report. 3. ATR, sizing your positions. 4. Dynamic stop-loss strategies. And 5. Real-world trading scenarios.
Section 1. The Volatility Survival Guide.
Let's start with a really critical question. Why do market crashes wipe out everyday retail traders while hedge funds just survive? Well, retail traders usually get taken out by emotional behaviors, panic selling, and by using rigid, static stop losses that just get hunted down by wide market swings. But the big institutional funds, they survive because they're using algorithmic trading, they've got deep liquid reserves, and most importantly, they use strict mathematical frameworks for volatility-weighted capital distribution. They aren't just guessing, they rely on hard math to avoid massive drawdowns.
I absolutely love this quote from financial theorist John Hull. He says, volatility brings about fresh uncertainties as well as fresh opportunities. It totally reframes how we should think about market turbulence. Volatility isn't just the enemy, right? It's more like a force of nature. Just like a seasoned sailor uses strong winds to their advantage, a disciplined trader uses high volatility to uncover fresh opportunities, as long as their risk management systems can adapt to it. Moving on to Section 2, VIX, the Market Weather Report. Think of the VIX, or the Volatility Index, as your macro weather report. It's an implied volatility metric derived straight from S&P 500 options pricing. People in the industry often call it the fear index. When the VIX is low, the market is pretty calm, maybe even a little complacent. But when it spikes, like we literally saw with record intraday levels during the 2020 crash, it's screaming that a massive storm is brewing. It gives you that crucial situational awareness to know, okay, should I be pushing for aggressive gains right now or actively hedging my portfolio? And it's fascinating to look at what actually drives the Sphere Index. Causal discovery models that track geopolitical risks show these direct chain reactions. For example, stress in emerging market bonds has a highly significant statistically proven causal link to driving the VIX up. It creates imbalances that echo across the whole globe. On the flip side, major conflicts or political instability show a really strong link with the energy sector ETF, the XLE. The market basically anticipates and prices in these conflicts in advance. So when you understand these triggers, you aren't just looking at the VIX as some random number. You're reading unfolding global narratives.
Section 3, ATR, sizing your positions.
Okay, so if the VIX is telling us the macro waters are incredibly choppy, the next obvious question is, how big should your boat be? That brings us to the average true range, or ATR. If the VIX is your overall weather report, the ATR is your micro navigation instrument. Developed by J. Wells Wilder, it measures the specific day-to-day price range of the exact asset you're trading, usually looking back over a 14-day period. So if a stock normally moves, say, $2 a day, and suddenly it's swinging $10 a day, your ATR is going to spike. It tells you exactly how wide those swings are so you can get your defenses ready.
Once you know your volatility, how much capital do you actually put on the line? Well, institutional traders rely on strict capital allocation models. A really common one is the fixed fractional method, which strictly dictates you never risk more than 2% of your total account on any single trading session. It's safe, but kind of inflexible. Then you have the Kelly criterion, which finds the mathematically optimal fraction of your bankroll to risk based on your win probability and reward to risk odds. But since we're human and we sometimes mess up those odds, a lot of pros use a half Kelly approach. They literally just cut the Kelly recommendation in half to drastically reduce volatility and stop severe drawdowns. And here is the absolute crucial takeaway. It's a hard mathematical rule. When market volatility, measured by your ATR, doubles, you have to decrease your trade size by 50%. Let me say that again because it is the cornerstone of surviving high volatility. If the market is swinging twice as wildly, you cut your position size in half. This is known as volatility targeting. It guarantees that your overall portfolio risk stays completely constant no matter how chaotic the market gets. You definitely don't want excessive cash exposure when things are acting unpredictable. Section 4. Dynamic stop-loss strategies.
Now let's talk about protecting that perfectly sized position once it's actually live in the market. This is where amateurs and pros totally diverge. Amateurs love static stop losses, like always risking exactly 50 points. The problem? When volatility is high, completely normal price movements will easily trigger those static stops before the trend even changes. You literally get shaken out of a great trade just because the market sneezed. Pros, on the other hand, use dynamic ATR-based stops. By setting your stop at a multiple of the ATR, like 2 ATR units below your entry price, your stop loss literally breathes with the market. It widens when things are volatile and tightens up when the market calms down. Trailing the market actively like this achieves two massive goals at the exact same time. First, it locks in your profit gains as the asset goes up, and second, it safeguards your position against sudden, unexpected drops. Because that trailing ATR stop loss adjusts in the same direction as the asset, you get to stay in the trade safely. You ignore all the daily noise, but you're still perfectly protected from an actual crash. Section 5. Real-world trading scenarios. All right, let's pull all this theory together, the VIX, the ATR, the dynamic stops, and apply it to a real-world trading matrix. Let's look at the Indian markets on July 10, 2026. On this specific day, our macro weather gauge, the India VIX, was sitting really low at 13.26. That indicates a very calm environment. A low VIX like this specifically favors option sellers because premium decay happens faster than uncertainty, and it usually supports a gradual upward trend for equities. Add in stable global markets, like a strong Dow and S&P, plus stable burnt crude, and the overarching macro risk was super low. The weather report was totally clear, pointing us to a mildly bullish market prediction. So knowing the weather is calm, here's the exact step-by-step decision tree a trader would use. Step 1, we verify that calm VIX. Step 2, we respect the Nifty's defined consolidation boundaries, which were calculated right between 23,926 and 24,094. Now, if we're hunting for a bullish breakout, we don't just jump in blindly. We wait for a 15-minute candle close above that 24,094 resistance line. If that triggers, step 3 is where our dynamic risk management kicks in. We place a precise stop loss at 24,020. That stop is mathematically placed just below the breakout zone. It gives the trade plenty of room to breathe, caps our downside, and lets us aim for profit targets, scaling all the way up to 24,530. Bringing this all back to your day-to-day workflow, we hit the absolute golden rule of trading, the rule of ruin. Whether you're trading the Nifty, the S&P 500, or commodities, capital preservation is always your number one goal. The math simply dictates that your risk of ruin must stay below 1%. That means you have to be disciplined enough to never risk more than 1 to 2% of your total trading capital on a single trade. By pairing ATR position sizing with this strict cap, your trade-by-trade losses are controlled so they never pile up to a point where financial recovery becomes impossible. So we'll leave you with this provocative thought regarding your own trading psychology and risk management. It is super easy to make money when the VIX is low and the skies are completely clear. But markets are cyclical, and the storms, they're inevitable. Have you actually stress-tested your portfolio? Are you using ATR to size your positions and trailing stops to protect your capital? Take a really hard look at your strategy today and make sure it's built to weather the absolute worst tomorrow. Thanks for tuning into this explainer, and happy, disciplined trading.